In this video, we'll look at staking crypto. I'm going to go through a step-by-step guide on how to actually stake a cryptocurrency, but also we're going to look at some of the staking providers and some of the things that we should be thinking about when staking, including what the risks are, what the potential rewards are, and if it's worth it or not. Timestamps for everything down in the description below. Other helpful videos and links as well that I mentioned in this video will be down there. Firstly, we want to look at crypto yield and staking. Is it worth it to actually go ahead and stake? Should we be worried about this? And what are some of the things we need to know before going ahead and staking? So I want to talk about that in this section. There's two ways to earn yield in finance in general. One is by lending your money to someone and they pay you an interest rate based on that. And then at the end of it, they should be able to pay you back. Now, the other way is to make an investment in some sort of endeavor that creates profits and then passes some of those profits back to you. Now, when you invest in stocks, that's known as a dividend, and on blockchains, it's known as staking rewards. It's the same sort of thing, right? They have to be doing something to provide you with this return. Nothing in life is free, and so we need to understand how much risk we're taking when we're getting a certain return, like 5%. In crypto, just like in traditional finance, these are the two ways that you can earn passive income. Now, it's important to know the difference between actual blockchain staking, which is buying a layer one cryptocurrency and staking it on the blockchain, and lending, which is also a massive part of the industry where you can gain yield. We'll go through both types and the pros and cons of both. Firstly, let's look at lending and some of the ways that you can lend. Now, in 2022, this year, as I'm filming this video, all of these CeFi lenders like Celsius, BlockFi, they all blew up. What they were doing is taking your dollars, right? Now, that could have been in the form of actual dollars. It could have been in the form of USDT. It could have been in the form of Bitcoin. They take the value, they sell it all into dollars, and they lend it out to people, and they pay you like 5 to 10%. Right? The problem is what you've just done is taken BTC and turned it into a junk bond, because anyone that's paying you 10% yield is obviously a bad debtor because they're paying a very high yield, right? So this is, a part of the industry. You can choose whether to go into that or not, whether to figure out whether 5, 7, 10% yield is worth it for the potential that during a downturn, everything blows up like it did in 2022. The other way to get staking yields is through exchanges when they tell you, hey, stake your coins here and we'll give you a yield. Some example of this is Binance, which I'm going to go through. They own 60, 70% of the market. And so, they have an earn product and they actually do things in a different way where they do it directly on their exchange. Now, what they do in some coins, but not others, is they give you a all-in-one solution where some coins that can be staked, they'll go and do that for you very simply, and they'll stake that for you so you don't have to worry about the blockchain stuff. Other assets, they may actually lend them out to traders on their platform. Now, in terms of Binance, all of their lending to traders is over collateralized, meaning someone puts $1,000 on account and they'll lend them 700. If their collateral ever gets down to around 700, they'll just start selling off their assets. That's an automated process. That is over collateralized lending on margin, and they do that on their own platform. And that is a lot less risky than just taking it and loaning it out to hedge funds at 10%, right? Which happened in crypto in 2022. So you can choose whether you think that's decent to get into or not, but I'll show you on Binance what they do anyway. Now the next is using DeFi to lend out. Applications like Aave, some other ones as well. What you can do, Venus is a good one. You can see them here. You actually lend your tokens out on DeFi. Everything is done via smart contracts, and so everything is over collateralized again, meaning that they can't really go bust. There are still some ways that the protocol actually can get a bad debt, but for the most part, it's actually managed pretty well. So you're lending your money out on an over collateralized basis, meaning the risk is actually quite low. There are smart contract risks, there are other risks. And as you can see, with lower risk, you get very, very small rewards. We're talking around 1 or 2%, right? Which is absolutely nothing. And you're getting paid for the lower risk right there. The other way is to LP. And that is actually when you put your assets up onto DeFi and let other people trade with them. They pay you some fees. You can take them out at any time. So all of this is really DeFi, lending and LPing across decentralized finance. with everything else in life, if you're getting a high yield, it's because you're taking very high risk. For the most part, you don't really want to be doing that. You just want to be paid a decent yield for taking very low risk. This is all risky enough as it is. Now, staking is completely different to this, where we're actually getting blockchain incentives. So we are putting our coins on the blockchain and it is paying us back a yield for that. Most blockchains, though, because they're new, pay that yield out from inflation. That is not yield. What the blockchain does is create new coins out of thin air in order to incentivize people to use the network and secure the network. So if you're getting a 5% yield from staking, but all of those coins are being created new, your net yield is actually zero, okay? Because you're getting fresh coins created. So what we need when we're staking really is to focus on the project itself and investing in the project itself first before worrying about staking about it. Staking is an add-on and you should do it because if you don't, you're actually losing 5% a year to everyone else, but it isn't a yield unless it's a real return, which I'll get onto in a second. This is secondary to the token performance. Do not buy anything because of a high yield, because if it's coming from inflation, you're not getting any yield whatsoever. The reason people stake as well, of course, is self-custody, because you can actually take self-custody of this. You don't have to rely on, any centralized parties or anything like that. Real yield when you stake anything, Cardano, Solana, Avalanche, BNB chain, whatever it is, this is the formula that you have to look at. Yield that you get minus the rate of inflation in those tokens is the actual real yield that you're getting. Let's do an example of this. Currently, as of making this video, US Treasuries, the 2-year Treasury is, I think, let's say 4.5%. I think it might be 4.6 or something like that. So you're yielding 4.5% on a 2-year Treasury. The risk-free rate, US government bonds. The rate of inflation officially right now is, let's call it something like 7.5%, right? Now, what's the real yield? Well, 3%, right? Is the difference between the yield and inflation. Well, hold on. Inflation is higher than the yield that I'm getting. This is a minus. So even though you're getting a high yield, you're still losing money. You're actually losing minus 3% a year. Let's say a protocol gives you 5% yield and the inflation is 5% because they're creating new tokens to give that to you. The real yield is zero. So if you don't stake, you will actually be losing out 5% a year. If you do stake, you'll be keeping yourself at zero. But the important thing is we need a layer 1 blockchain or any investment that we make to actually be making profits from it, which means that there's no token creation and those fees that are being paid on the blockchain are being used to give you yield. Just another example right here, as you can see, let's say that ADA pays 3% staking rewards. It pays them to me and it pays them to everyone else. I am no better off because everyone has 3% more tokens that have been created out of thin air. It's the same as a piggy bank. If we both have 2 shares of one piggy bank, that's $1,000, each is 500. If we create more tokens and give them out to everyone, the piggy bank is still worth the same amount. You just have more tokens to split it across. So what we need is a profitable blockchain that actually makes fees and passes those back to us to actually be earning a real yield. Like I said, though, if you don't stake, then you'll actually be losing out in comparison to everyone else, and your investment will be getting diluted via that inflation. That's why you have to stake, because you're getting diluted otherwise. Or if the blockchain actually pays a real yield because it's a profitable blockchain, then you're getting actual real yield on top of your investment. And so the only two to do that as of making this video are Ethereum and BNB coin. Let's look at how to actually stake then. And like everything in crypto, there's centralized and decentralized solutions. And it depends who you are in terms of which one you choose and how much crypto that you have. The more advanced you get and the more crypto that you have, people usually tend towards going to the decentralized options and getting a wallet or even a hardware wallet, to take full self-custody of their assets. But of course, you have to be more advanced there. And there are some issues around keeping your seed phrases correct and everything like that. So let's start off with the easiest option, which is a centralized exchange. I'll show you Binance here. As you can see, they have an earn product, which is simple earn. And some of this is lending to margin traders on their own platform. And some of it is being an intermediary to stake your assets for you. Now, the downside of any centralized solution is that you have to trust them to keep your assets safe, right? Now, the upside is that it's very convenient, and actually, as long as nothing crazy goes on, these guys actually have very good cold storage solutions, right? And so they have the top of the line stuff. And so there's always a balance here. What I would suggest is whoever you're using in your country, just use someone that is upstanding and is regulated or is, getting regulated, right? Because this is all very new. We can also look at proof of reserves. So if you go to CoinMarketCap, you can look at all of the exchanges and you can see which exchanges do proof of reserves to show you that they're holding the crypto that they say they are. You can see all of that. So if you use an earn product like this, you can see they kind of bundle staking and savings in one thing. So you have to be careful about what you're using. But with Binance Earn, you can just search for a coin. So let's look at BNB and see what we get. Now on BNB, this is Binance's or the Binance chain coin. And so you can see you have a few different options right here. Now BNB coin pays around 5% in staking yields. So you can stake it right here. And as you can see, you can just subscribe right here. It goes right through. You can look at the options. You have 30, 60, 90, 120-day lockups. There may be available quotas as well. As you can see, the quota for 120 days is only 0.5 BNB. It's not a lot. For 90 days, that product is sold out. For 60 days, you can put a ton of BNB on here. And you can see the yield is 3.26%. That's actually lower than you can get on BNB chain directly. So do you want to do this or not? It's up to you. 30 days, you can have a ton of BNB right here. And the APR is 3.2%. So that's very easy. You just go and subscribe. Buy the BNB coin on Binance, and that's it. And you can subscribe here. What about other options? For example, Matic, which is another staking crypto, 13.9%. We can subscribe here. You can see that the available quota is 250 Matic, which is around $300 or so right now. So again, like not a ton that you can put on here for that interest rate. If you go down to 30 days, you can put a lot more Matic on, but the interest rate goes down to 4.6%. Now, Matic, the blockchain itself, is paying around 5% yield right here. So you can see you're not earning much more. And with Matic and BNB, you'll have to look at what exactly they're doing right here, but I would assume they're just taking these coins, staking them on the blockchain for you, and passing back some of those staking rewards and taking a cut out of that, whatever it is, maybe 5 or 10%, a fee from the yields that you're getting to actually run all of this infrastructure. So if you just trade on something like BNB or other centralized exchanges and you trust them and they're regulated and they have proof of reserves, then that's something that you can do, and you get decent amounts. Now, as you can see here with other options, for example, US dollar tether, USDT is a stable coin and you can't stake this thing, right? It's not a staking blockchain, but you have an earn platform here where you can essentially lend it out to traders on the platform. Binance say that this is safe because everything is over collateralized. You can see the tiers here. So you get a 5% yield on $1,000. Now that's a lot better than you get in a bank account. It's actually better than you would get in a US Treasury right now for locking your money up for 2 years. But only for $1,000, and then anything over $1,000, it goes down to 0.7%, as you can see. So again, there's some risk here putting your assets onto a exchange that doesn't have FDIC insurance or anything like that, but there are some yields here. And if you're trading anyway, you can subscribe to these and actually get flexible interest. So that is one option. And if you are happy with leaving your money on the exchange, then you can use something like this. I'll leave a link to Binance below because they give deposit bonuses and trading bonuses as well. As people get more advanced with crypto, they want to look at taking custody of their own assets and actually staking things on the blockchain. So let's go through that process. The first is, let's look at which cryptocurrencies are actually proof of stake that we can go ahead and invest in. Well, what we would look at is all of these cryptos right here. Most layer 1 blockchains these days are proof of stake if you want to invest in those. So we can look here for Ethereum, BNB Coin, Cardano, Polygon, Polkadot, all proof of stake. You can go to the website, the official website of the crypto and look around at the docs, or you can go to something like stakingrewards.com. It's going to list out all of the proof of stake cryptos, give you information about what they pay. So that's really important and a good resource. I'll link everything in the description, like I said. Now what we want to do is obviously go ahead and buy that crypto or get hold of that crypto. But importantly, we want to bring that out to the blockchain. So what we can do is go ahead and buy any cryptocurrency. I'll show you BNB here. Buy BNB on Binance, then withdraw it from your exchange. You need an address to withdraw it to, of course, which is a decentralized wallet. So what do we do now? We can go to something which is a native wallet to that chain. Every single blockchain has a native wallet. BNB chain has Binance chain wallet and Trust wallet. If you're looking at other chains, something like Cardano is going to have Yoroi. So every single blockchain will have a native wallet. Just look it up on Google to what it is. Now, people often get a ledger device as well. Most proof of stake cryptocurrencies can be staked with a ledger device. This is a hardware wallet. So what you do is buy the hardware wallet, take the crypto onto the hardware wallet, and then go and stake it through something like the blockchain wallet like Yoroi. So what you do is you have a ledger, you link the ledger up with the software wallet on your device, and then you can use both. So you have cold storage, and then you have the hot wallet that's interacting with the blockchain that you can use to stake. Now, I've got videos on Ledger. I've got videos on all the wallets that you might want to use. Check them all out in the description. What we can do is go ahead and withdraw the crypto that we want to stake over to our wallet. So that's step 2, find a wallet, right? So every blockchain will have an official wallet that you can use to stake, and most of them link up with a Ledger device. Ledger is what I use, and so it's cold storage and very, very useful. Check that video out in the description as well. I'll link it in the description as well for you. Step 3, understanding staking concepts. When you stake a crypto, there's things you need to understand. The first is there may be a lockup. When you stake a cryptocurrency like BNB chain, I think the lockup is 9 days or something like that, maybe 7 days. For Polygon, the lockup is 9 days. So you stake, and if you want to withdraw, you have to wait 9 days. That isn't very good. And so there are other solutions that actually help us out, which I'll talk about in a second. Lockup and unstaking is the same thing. So if you want to unstake, you have to wait 9 days. It's an issue. And so you have to be sure that you want to go ahead and do that. Slashing is something that happens to bad validators in the network. When you are staking, you are giving your coins over to a validator who's helping to run the network and process the transactions. Many blockchains actually have what's known as slashing, which is where they punish bad validators. If your coins are with a bad validator, your coins could also be slashed. For the most part, if you are staking your assets through top-end validators in a network, that's not going to be an issue. So we buy the crypto on exchange, withdraw it to our wallet, and then we go into the wallet to actually stake. Every blockchain wallet will have an official staking portal. This is the portal on Yoroi, which is Cardano staking. Cardano doesn't have slashing. It also doesn't have unlock times because of the way that the protocol was actually made. And so it's great for staking. As you can see here, all of the validators are right here. You just have to search for them and pick one that is a really decent validator that's up all of the time and that's paying a decent reward. And that it actually shows us kind of the best one sorted right here. And then just click delegate. Now it may be called something different. It may be called stake, delegate, whatever it is. But your coins are now going to be given over to this validator, and they're going to help run the network and pay you this yield. Now, with Yoroi, you can very easily unstake. You go to the dashboard, look at your staking, and it's literally just undelegate, and it's literally straight into your account. There's no lockup on Cardano. Other chains like Polygon and BNB chain do have lockups, and so you're going to have to wait to actually get your coins back. If you want a step-by-step guide on getting that done for many of the most popular chains, all of those videos are linked in the description. But the next step after staking is, can we earn extra yield opportunities, or are there different things that we can do to actually make our life easier when we stake? Because staking deals with such large sums and deals with yields that are passed back, there's a massive staking industry in the decentralized world that gives you some better options with staking. So I'll show you that now. It's called liquid staking or liquid staking derivatives. Now, what this does is it stakes your coins for you and passes the yield back to you and gives you an easier way to stake rather than having to do it and lock up your coins and deal directly with validators. So the downside of staking is that you get lockups, like I said, between 9 and 21 days. That's not great. The second downside is that your capital is tied up because it is locked up. So let's say you want to sell your coins and you need to wait 21 days to unlock them. That's a big issue if you want to sell your coins straight away. So the other downside is that with staking coins, you can't do anything else with them, right? You can't use them, you can't lend them out to get even more yield. Even if it's a little bit of extra yield, if the risk is low because it's on DeFi, then you're not able to do that. And so you're missing out opportunities. That is why these new coins exist called liquid staking derivatives, and I explain how they work. Liquid staking providers do all of that work for you and stake everything on the blockchain. And then in turn, they give you this token, which is a derivative of the one you gave them. And it accrues the staking rewards. But the difference is that it's liquid. It's not the token that you've locked up. So this is kind of how it works, right? So you can rely on smart contracts to actually stake your tokens and then get this other one in return. So if you have Matic, for example, instead of staking it on the blockchain and locking it up for 20 days or 9 days in Matic's case, what you do is you give it to a liquid staking provider like Lido. They take that coin and they stake it on the blockchain. At the same time, they give you a liquid staking derivative known as staked Matic or ST Matic. Now, this is redeemable 1-for-1 with this coin. It therefore in the market has the same price as that coin. It should do because it's redeemable 1-for-1 and people will come into the market and arbitrage away any differences. If the price of this gets below a 1-to-1 ratio, then people are going to come in and buy it and force the price back up as 1-to-1. And so what you have is you have a token right here that has the same price as this one and accrues the staking rewards, but you can trade it. It's in your wallet. You can trade it around on DeFi. You can use a decentralized exchange to swap it out. You can send it in somewhere and swap it out, right, if it's supported. And the way that this actually accrues those staking rewards in staked Matic's case is actually the price goes up a little bit. So what you will do is essentially have a token that gives you this Matic's worth plus the staking rewards 5% a year. So this token right here, this staked Matic token, should actually increase in value by 5% per year in comparison to Matic if the staking rewards are 5% per year, right? So whatever the staking reward is per year, that's what this token will go up in value. So instead of having your coins locked up on the blockchain, you now have a token that's in your wallet, is accruing staking rewards, and also is something that you can swap around and trade instantly and no lockups. So that's the benefit of liquid staking. Now there are liquid staking providers, and so I'll show you these. Lido is the main one. And so what you can do is come down and actually stake your coins right here. So what we do is go to our exchange, buy the token. So you can do that here, Matic, withdraw it to your address. So you can use MetaMask wallet because Matic is on MetaMask wallet, and then go to stake now on Polygon Matic, and then go and stake it. So you can see Connect Wallet here, put in the amount of Matic that you want to stake, and Connect Wallet and stake it. Now Matic is a little bit strange in that with Lido, they actually only stake Matic this way on the Ethereum chain. So you're going to have to withdraw your Matic on the Ethereum chain. But other chains like Ethereum, that will be using the Ethereum mainnet as well. On Solana, if you press stake now, you'd have to connect a Solana wallet like Phantom, get Solana in there, and then stake it through this way as well. You don't actually have to do this though, because remember, these liquid staking derivatives are tokens that are traded freely that accrue staking rewards. And so instead of having to go through all that and actually stake your coins and get them onto Lido or another provider like Stader, you can just buy them directly. So what you can do is go to an exchange that supports the staking derivative. We're on QuickSwap here, which is on the Polygon network. Connect your wallet, have some value in there. You can have US dollar Tether, you can have Matic coins, and then we want to swap the coins. So we can trade value like Matic, and we can select a token, and I'm going to select Stake Matic. That's it right here. This coin is that staking derivative. So if we buy this, we have that staking derivative in our wallet that's going to be accruing those staking rewards for us. So we can swap any amount of value. We can choose Matic here. We can choose USDT if we have that stablecoin. We can go ahead and buy directly staked Matic. So we don't need to use the Lido provider ourselves. We can actually just go ahead and buy the token because it's a liquid staking derivative. So it's a liquid token that we can trade freely that accrues those staking rewards directly in our wallet. So if you have a coin or a blockchain that uses this type of technology, you can just go ahead and do that. What coins do this? Mostly it's EVM chains. Chains that are using the EVM, which is the Ethereum virtual machine. So Ethereum, BNB chain, Polygon, and a few others as well. Step one is to get some sort of value into your wallet. whether that's USDT or the coin itself like Matic or BNB. Step 2 is to go ahead and buy the staking derivative on a DEX like QuickSwap for Polygon or PancakeSwap for BNB. And step 3 is just to chill because you're getting those staking rewards right in your wallet. What are the risks though of doing all of this? Well, there's risk in everything. The least risky is just to directly stake your tokens with the native wallet of each blockchain and just leave them there. That's the least risky, that's the least moving parts. Then I would say you have liquid staking derivatives where there is a centralized provider in between you and the blockchain right here, but all of the staking rewards and derivatives and everything like that are based on smart contracts. These are open source smart contracts that people can view. And so you expect these to be fairly robust in terms of the strategies here. They are just smart contracts. And so they're not a centralized entity that can misappropriate your funds or do anything with them, right? So it's kind of direct as well, which is why so many people use these days. And then you have centralized staking and earn products, which you have to rely on that business that you're staking with, that it's doing the right thing and it's not going to lose your money. So with everything, there are risks and rewards and different yields that you can get in terms of staking and how complex you want to be with all of this. I have other video guides on how to stake and how to use wallets in the description. Definitely check out MoneyZG Academy as well. I'll link that in the description. We have about 50 or 60 videos that goes through DeFi, how to trade, how to manage your portfolio and how to stake and everything like that. I think that'll be very useful for a lot of people. Everything is linked in the description down below. I'm James with MoneyZG. Cheers for watching and I'll see you in the next one.